fresh off the press, 53 pages, your top picks for 2020. And I was shocked. Number one is Uber. How the heck is your top pick Uber?
So it's our Facebook of 2020. It's a dislocated stock. It's unpopular. It's a failed IPO. It's got this Eats business that's losing a lot of money. Nobody wants to buy Uber. We think the story is going to get better and better as we go through the year. So dislocated stock is more likely to have upside like Facebook did. We think the economics are starting to prove themselves out in the ride-sharing business. And what this company has to do is bring down operating losses each and every quarter. We think they will. And we think by the end of 20 and going into 21, we could have a break-even quarter. And you want to buy a stock that's going through that kind of inflection quarter.
And more so than Lyft because of its diversification rather than a pure play rideshare?
I think these are probably joined at the hip. It's kind of hard to see one dramatically outperforming, if not the other. What I find is that shorter-term oriented funds have preferred Lyft because it doesn't have the food business and it's just in the U.S. market. But the flip side of that argument is that Uber has more levers that they can pull to get to profitability. They can sell one of their loss-generating international assets. And they also have 70% market share in the U.S. Generally, the company with greater market share determines economics. That's Uber.
How do they overcome AB5 in 5-10 days?
I don't know. I don't think that'll be implemented immediately. I think this is going to be a court fight. And we think that it could lead to something like a mid-single-digit percentage increase in our cost structure. So just keep in mind, there's 2 or 3 hedges here. First, Uber and Lyft gave out a lot of subsidies to drivers in order to get them to drive with Uber and Lyft in the first place. If you're giving them benefits, there's less need to give out subsidies. And second is they can pass some of these expenses on to consumers. And third is there's only a small percentage of drivers for these two services are actually full-time drivers. Those are the hedges.
I want to come and take a look at number 2 and number 3 top picks. Okay. Google and Facebook. With all of the risks, the regulatory hang, the antitrust, Google and Facebook are number 2 and number 3.
I think it's highly, regulatory fears have been rising for a couple of years. You and I have talked about this a couple of times. And I just think we're close to peak regulatory fears. I think it's highly, highly unlikely that these assets get broken up, in which case we've already seen the worst of it. We've seen fines imposed against both companies. And by the way, it hasn't impacted either of their advertising revenue growth rates. The little interesting angle on Google is, as its cloud business has finally gotten scalable and big enough, it may be less of a drag on margins, so you could actually have a positive earnings story out of Google this year. And then with the two co-founders kind of stepping aside, we may get more rationality in some of their investment spend in what they call the other bets area.